Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Friday, February 21st, 2025. I know I had previously said I would move Friday's show to Sunday. I couldn't help myself. I have to do today because it was such an exciting day. In the future, I'm thinking for the weekend in general, I'll either do a Friday or a Sunday show, try to get one in at least before the following trading day. So let's dive in. Today's episode begins with engulfing red candles everywhere. Whether you're looking at the S&P 500, the Qs, the NASDAQ, small caps, the IWM, semiconductors, the SMH, the Dow, you name it, it sold off today as far as U.S. equities go, especially. CNBC has a headline, Dow dropped 700 points for worst day of 2025 so far on new fears about economic growth. This involves the consumer sentiment report that came out today, February 21st. You can find this on Market Watch. The expected of the consumer sentiment overall number was 67.8, expected to stay the same as the last month's reading of this and dropped to 64.7. Also a little bit of a crack in the flash PMIs, notably below 50 now. Anything below 50 is a contraction, and although it's not very below 50, it's only 0.3 below 50. It is below 50 when the expectation was to stay around 53. Diving into the consumer sentiment report, you have from the article of CNBC.com, we have supposedly people are concerned with tariffs, and the sentence right here pretty much sums up the major headlines that you'll see. The 5-year inflation outlook in the survey was 3.5%, the highest since 1995. What's kind of funny about the fear of inflation, this is at a multi-decade high peak, people's fear of inflation. And if you think about that, what fear of inflation typically does is get people to buy things sooner than later, and that can contribute to inflation actually accelerating to some degree. I find it to be interesting that we're now getting many earnings report after report of companies like Walmart and others out there that are sort of reporting the opposite, that we're already, maybe, and my take on it is that maybe this is actually over now, that like people have everything that they think they're going to need over the next 5 years. They don't, they already have the car they need. They already have the, whatever it is. However you want to look at it, the stock market declined pretty heavily today, I'd say. But I find it interesting that credit spreads didn't spread at all. So the bond market is saying, okay, risky credit doesn't have any risk. There was zero movement really in high yield corporate bonds today. So that tells me personally that this might just be a knee-jerk reaction that can actually reverse the other way pretty quickly. But seeing as though, PE ratios have been so high, I mean, when PE ratios, by the way, are so incredibly high, it means that the market is doing something called, pricing perfection, as you've probably heard that phrase many times over the past at least 6 months. And when things are not perfect, then, the market can fall very, very dramatically because of how much speculative value has been priced in. It's a lot, and it doesn't take much to have enormous drops in the S&P 500 when, it's clearly overvalued, however you want to look at it. I mean, I'll add that the market dropped in the face of the Fed funds futures. This is the investing.com site. Today, a chance of a cut actually rose for the May meeting. And so again, this is saying, the Fed's not going to cut fast enough now. We're back to that part. It's like one day the market is worried about the Fed not being tight enough, with inflation going higher, with bond market selling off, with yields going higher, and then the next day, you have the market saying pretty explicitly that we need more cuts, that there's a fear of a slowdown more than there is of anything heating up. Just this whipsaw back and forth, it's like almost a chart of its own. So, I mean, I still am in the camp that I think the stocks are clearly overvalued, bonds are clearly undervalued, and the Robschild portfolio certainly had a very nice day compared to all of the stock indexes. My portfolio did very, very well today. But we'll get through all the details and charts in a moment. Second thing on the agenda, next big report, is really the PCE data coming out Friday next week. And in the meantime, there's also NVIDIA earnings, which can affect stock valuations overall. I mean, like people often say, where this, follow the semis. Ever since the dot-com bust, the semiconductor SMH has acted as a pretty good leading indicator for stocks, and with NVIDIA being the biggest one in its category, its earnings report, I mean, if it doesn't come out blazing hot and making tons and tons of more money, we're in the hot air balloon, and we went up really high, and the market is eventually going to look down and see how high that we've gotten and how far the reasonable ground seems from here. No major changes in the daily reminders. Watch macro update 2/11/25 to hear me read through these very important things that give me all of my investment ideas. And you can find my explanation of my crystal ball readings and portfolio update in the video titled Portfolio Update 2/11/25, where I also explain all of that. On to the charts. We'll start with going into the S&P 500, the SPX. Holy moly, what a big red candle we had today. I said yesterday that we had a major breakout from this very psychological 6,100 level, and a confirming candle saying the bulls are indeed in control here, and it is most likely for the market to go higher. And today, whoa, we cracked right back down through this. This sort of negates this level at this point. I mean, we'll need to see a lot of strength. We'll need to see it bounce back quick on like Monday or Tuesday for the bulls to regain control. Otherwise, it looks like the bears are in the driver's seat from my eye, going down 1.7% today. Also, the small caps having a very, very big drop, 2.88%, and the semiconductor industry dropping by over 3% today. So Robschild, fear of inflation, that sounds bad for bond yields. Bond yields are surely going to keep going up. Well, they didn't. The 10-year Treasury note yield collapsed today, actually 1.8%. Breaking down out of this previous parallel channel, which I'll delete now, clean up some of these other lines here. We can see now that we have a lower low, lower high, lower low. This is currently looking bearish on yields, which is why the Robschild portfolio did so well today. TLT breaking also above this previous little bull flag looking thing here, closing 1.2% higher. Zero ZNTMF, of course, having much bigger gains than that. From a charting standpoint alone, this looks very bullish rather. We have the flag here, we have the pole here going up, the flag here, and the breakout. As I said earlier in the show, it would have made sense for me for this fear to widen credit spreads at least a little bit, but we didn't get that. HYG going down by only 0.19%. This is nothing like the yen carry trade blow up or other major events. high yield corporate is still hanging in here pretty strong. And just another way to look at that again from the Fred, the high yield spread between high yield corporate bonds. These are mostly around 5 years, by the way, and treasuries actually dropping today. So, it's kind of funny. People always refer to the bond market as smart money, and it's smart as in like it doesn't have as bad of knee-jerk reactions. The bond market is saying here, this is already overextended to the downside. So it'll be really interesting any which way we look at it going into next week. Another market that's not giving us major bearish signals yet is DXY. I was kind of surprised to not see the dollar rise more strongly today. For a true correction to really continue in the stock indices, I need to see the dollar going higher to fully believe it, along with credit spreads widening. Once you get that ball rolling, that's when you know we have a continued downward momentum. As it stands, we're sort of at let's call Mr. Market has some cracks in his shield. Or if you like video games, it's lost a fair amount of durability points or whatever, and needs repair but isn't broken yet. I find it ironic that the fear of inflation can drive oil prices down. I guess it's not that unreasonable. If you think about it, inflation means people have less money, and it's expected for the economy to slow down, and therefore, it will slow down people buying oil. And oil's not something that you can load up on, or not your regular person anyway. You can buy stocks in oil companies if you think oil's going to do well, and help pay for your gas as prices go up and the company's making more money because you're making more money off of owning those companies rather. But anyway, yeah. So oil major collapse today. I've recently just said yesterday how the oil market, this has been getting extended, and the longer that we go sideways, the less strong this previous engulfing red candle becomes. And the fact that we have from this little area here anyway, we have a new closing low below any of this, and it engulfs 1, 2, 3, 4, 5, 6, 7 previous candles. This is extremely bearish looking, and so oil looks like it really wants to get back at least down to this $67 infamous level. Again, back to 2021, we've been beating on this line over and over and over and over again. Is this it? Will it crack? Because when this does crack and goes down, the technicals suggest that we're headed perhaps as low as $35 a barrel again, and that's your deflation. That's by the way when bonds go to the moon. This could be coming really, really soon. Bitcoin yesterday looked like, and today's candle even as well, I think earlier in the day, had looked like it was, maybe we were cracking out of this very tight range to the upside. I said yesterday, I need to see a big solid candle to believe we're really going to be driving up or down from here. And we're back into the same range here. We're back to the middle fight zone. Bitcoin, like I keep saying, the longer this battle goes on, the stronger the breakout is going to be. We are preparing for a major, major breakout in Bitcoin to the downside or to the upside. So very exciting. One way to play this is to buy, I believe it's called a strangle. You can get options contracts. You get a call and a put, so like equidistant from the current price from each other, so that if you're expecting a wide move and you don't know which way it's going to go, because what happens is, as long as it goes above the premium of the contract or below the both premiums of the contracts added together, then you make money. And when you have such a tight range like this, the contracts tend to get cheaper because the expected move of Bitcoin tends to also coil up with it. And so could be worth trying to check out strangles in Bitcoin right now. So what does Dr. Copper think of all of this? Bearish on copper? At least on just today's information, copper to me is saying, yeah, more slowdown. And again, like I shared the other day, the copper to gold ratio being basically near all-time lows, the slowdown is coming. Everybody's saying, it seems. Also, a fear of inflation tends to send gold soaring. And what do we have? 3 dojis in a row. This is not bullish looking at all. This looks like it may even be a top in gold. Hard to say exactly. Last few charts amongst the chaos, amidst the chaos in U.S. equities, the Chinese equities went up by 3%. K-Web popped by 3% today, greatly benefiting the Robschild portfolio. Again, I'm looking for, $40 to $50 range. I think we're headed to $50. It's still undervalued at $50 to me, just not insanely undervalued. That's when I'll be selling. That's where I'm expecting it to go. I've talked about in previous shows how certain markets can do well while all of the U.S. markets seem to be cracking. This is one of them that can do that. Also, my largest stock holding, Nissan, did exactly that today. During the dot-com bubble burst, Nissan did really well. This is an AI. It feels exactly the same. AI bubble going on with, Nissan having a perfectly healthy balance sheet from the way that I see it, going up by 5.4% today. Like I said, the Robschild portfolio performed pretty well today. The only thing left is high yield corporate to start cracking for credit spreads to start spreading, which may happen next week. This may be the year of the dragon for the Robschild portfolio. Last chart I wanted to share today from the Fred, the M2 money supply. We have a report coming out. I love this as the next release dates up here. This isn't something that's super well kept track of. It's not on, I don't believe it's on Market Watch. Everybody uses the Market Watch calendar for these economic reports, but here's one that might sneak under the radar. The M2 money supply. On the 25th, that's on Tuesday, is the next release for this for the January money supply. And remember, typically the money supply pretty much always goes up. There's a better view. Again, if you know someone at the Fed, get rid of this button or put it over here on this side. Put it somewhere where it doesn't block the most important part of the chart. It drives me crazy. I digress. Even during most recessions, the M2 money supply expands. It goes up. Okay, the fact that we have been having this dip here is just major, and we have not even gotten back up to April of 2022 M2 money supply yet. If this turns back to the downside, if January's report shows like a lower M2 money supply than December, yeah, that could be the blow that breaks our armor. It reduces our durability to 0, and things really start falling apart. But I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.